you for joining. My name is Robyn Siegel. I am an attorney and I am also a mortgage broker. I've been in the industry for 25, 30 years, so I've seen a lot of ups and downs. Here, I've done this kind of outline before. It's 10 tips for the new year, 2026. And this time, I want to talk about a lot of changes or nuances that may come up that will affect you, your borrower, your time frame, and the closing. So this is just a bit of beware or be aware of what is going on in your clients, your buyers, mostly the buyers, the process. So we'll start with loan amounts, which have increased again, but not as much as they have in the past. So the loan amounts are based on the median home prices, which are estimated by the Federal Home Administration. They revise them every year. They go back and they see the price increases, the volume, et cetera, and then they decide how they want to increase or how much they want to increase the loan amounts. This year, from last year, you have the attachment, but just single family house went up from 806,000 to 819,000 about. So you see the change is about $15,000 higher, which means that the prices haven't increased as much as they have in previous years. And this could be overall. This is federal. It's countrywide. So, some areas obviously are less or lower than others. In our area, in the New York State area, and some other states, there's also high balance loan amounts, which have also increased. This is also on this printout. The high balance loans are somewhere in between conforming and jumbo, which means that if your client is buying a house and the mortgage falls into this high balance loan amount category, they can get, it's like conforming plus, we'll put it. So some jumbo loan rates are higher than conforming and high balance. So your client will benefit by getting a lower interest rate. So that'll be helpful. And again, it's in this form. The reason why I bring this up is that the loan amounts are as of January 1st, 2026. Lenders have allowed buyers to start submitting loan applications with the higher loan amounts now. The question is, will they close before January 1st? Most of them will, but you also want to make sure because rule of thumb, 45 days, 60 days. So we're still at October 15th. You just want to make sure that the lender that your buyer is going to will close with the higher loan amount. And you just want to confirm this because that could cause a problem. All right. So higher loan amounts. The other form, I didn't give you too many attachments because, not necessary. But the other form we have is the loan level pricing adjustment. Loan level pricing adjustments is how Fannie and Freddie will increase the pricing or the cost of the loan based on different factors, buyer's factors. Credit score is always the most important. Loan to value, that affects the pricing. What type of property? A one family will have better pricing than a four family. A primary home where they live will have much better pricing than an investor owned property. Overall, it's really just credit score, loan amount, and use of the property and number of units. But the form that I actually printed out is very small, forgive me. And You can glance at it. It's kind of interesting. I'm not going to go through it, but this is across the board. This is Fannie and Freddie, so the lenders do follow with this. All right. So just be aware that, if your client's shopping for an interest rate and they're quoted one rate, but then things change once their credit is run, or, they start with, I'm only putting down 3%, or, oh, it's a 3-family house, it's not a 2-family house, things will change. So they need to be aware too. All right, so that's number one. Point number two, AI, which is all we hear about, is also becoming very involved in the mortgage industry and the lending industry. Every aspect of the industry, as well as our lives, but specifically here, is going to get affected by AI. Loan applications. As time goes by, I started in this industry 30 years ago. We took a manual handwritten loan application and then it was typed out. Now it's a portal. People log into the portal. They could do it from their phones. It just goes from question, answer it, move on, question, answer it, loan amount, property address, employment, assets, etc. Everything is can be done in the portal by the potential borrower. Once everything is entered, then they have documents that the lender will request. They all request the same documents. They all ask the same questions. The process is the same no matter where your client goes. But with this, you really want your client to still go to a reputable lender, a larger lender, a lender that has history, longevity in the industry. The issue is that, as always, a lot of lenders pop up in the industry, and people find lenders online. I could go right now into my computer and go into ChatGPT and say, list the top 10 lenders that will do an investment purchase 10% down in the state of New Jersey. And literally, they will spit it out in 10 seconds. Then I can go through each lender and see which one, because I'm a buyer, is going to give me the lowest interest rate, because that's where I'm going to go. They don't think that each lender, has to know how to do the individual product or the program. Their underwriting is important. Their back office is important. So for you really care where your client's going for a mortgage. If your client is buying a co-op in New York, you want to pray that they're not going to a small lender in Tennessee, because they don't know how to do co-ops. More importantly, they don't know how to close co-ops in the state of New York, because it's very specific. So with that, you want to know where your client is going. It's important in the beginning of the process. Even though we're using AI, and even though it's easier to apply for a mortgage, put the data in, upload the docs, it doesn't stop there. Even if the client gets an approval in, let's say, immediately, 24 hours, 2 days, there's still documents that need to be manually reviewed. So people think that AI is going to replace a manual underwrite, the people, but it won't, because they're still uploading pay stubs and W-2s, tax returns for self-employed people. They're still uploading asset information, bank statements, IRAs, all sorts of stuff that still and probably always will need to be manually reviewed. Now, of course, the credit report, which is a tri-merge credit report, is pulled by the lender or the loan officer, the mortgage broker, and is the same. Everybody goes to the same, let's say, 5 places. It's a tri-merge. All 3 credit bureaus get merged together, hence tri-merge. So that is instantaneously and is done online. okay? But it's still manually reviewed. Income and employment can be quickly verified by using online income or employment verification sites. They could do that, but the people still need to upload documents. If something pops up in the verification, let's say somebody has a monthly payment that's taken out of their paycheck and the underwriter sees it, and it turns out that they have a lien against them or they're paying child support, automatically that is a debt. So not only is it a debt that will be added into their debt to income ratio, but they'll also require additional documents. So even though we are using better technology and things are faster, we're still going to have questions throughout the process. Point being, people think that they apply for a loan, they get their approval in 2 days, they could close in 2 days. I would still keep my mortgage contingency time 45 days, 60 days, whatever you normally do. Don't shorten it if your client's getting a mortgage, all right? So again, be involved in the process. Ask for a copy of the commitment letter. Look at the conditions. Ask your client if the conditions have been sent in. Ask for an updated commitment letter. Give yourself some checkpoints and dates where to check in with your client, where to check in if you have any conversations with somebody at the bank. You want to find out what's going on, all right? So you want to be aware and be involved. You don't want to just do it in the beginning and then at the end of the process, because things may turn up. All right, so number 3, appraisals. Appraisals and inspections should still be done. Realtors are always asking buyers to become more marketable and waive mortgage contingency, waive inspections, waive appraisals. This causes complications, all right? And people get caught up in it, and I don't blame them that, there's a bidding war because there's only 7 houses available in Hastings and they have their eye on one, and the realtor said, if you waive your mortgage contingency clause, you'll have a better offer. You'll look better. But even though they waive it, doesn't mean that, they still don't need to do all these things in order to get a mortgage. So if somebody's waiving their mortgage contingency clause, okay, that may cause a problem for you, for your buyer, if the loan to value is very high. If somebody's waiving a mortgage contingency clause, meaning if they don't get the mortgage, they'll come up with the cash and they're putting down 20% or they're putting down 50%, not such an issue. But if somebody wants to waive a mortgage contingency clause and they're only putting down 5%, 10%, you could have an issue later on if the appraisal comes in not at what you want. All right, so I did include a little loan to value calculation because I wasn't sure if it would be confusing if I went through it verbally. So in our example, real simple, so you could do math in your head if you can. The client is buying a house for $100,000. They're putting 20% down. They don't want to pay PMI. They have an $80,000 mortgage, right? 80% loan to value. The lender does the appraisal. The appraisal comes in at $100,000. No problem, no question. Loan to value is based off of contract price or appraised value, whichever is lower. All right. So if the appraisal comes in at the contract price, you don't have an issue. As a side, if the appraisal comes in higher than the contract price, the client cannot get a higher loan amount based on the appraisal just because it came in higher. Most appraisers will not come in any higher than 10% above a contract price, because lenders don't like that. If you're buying something for 100, the appraisal will come in at 100. more than likely never higher than 110, even if the buyer thinks the house is worth 150, the bank might not accept anything over 110, so the appraisers know this, all right? So going back to the example, if it comes in at contract price, your loan to value is fine, right? Contract or appraisal, whichever's lower. Now, where does this get hairy? If the appraisal comes in lower. So again, for easy calculation, you're buying a house for 100, the appraisal comes in at 90,000. If the client wants to keep the loan to value at 80% in order to avoid PMI, they will have to reduce the loan amount to $72,000, which is 80% of the appraised value, right? So that means the client needs to come up with $8,000 more for a down payment. If they have it, it's not an issue. If they don't mind, it's fine. But if they don't have the additional funds, the question is, where are they going to get it? So we can, as an alternate, increase the loan to value. In our example, 80% of a $90,000 appraisal is going to be roughly 88.88% loan to value. This means that the client does not need to come up with any more money, but they're going to have a higher loan to value and they're going to pay mortgage insurance. If they don't care, they don't care. But if they don't want to increase their loan to value and they don't have the money, where are they going to get the money? So they can get the money by gift. They could get the money by borrowing against their 401k. They can get the money by taking money out of an IRA. There are places where they could get the money, but the question is where and how do you need to document it? Because this is not something you want to document the week before the closing. So as soon as the appraisal comes in, this should be one of your checkpoints. You want to know, did the appraisal come in at value? All right, at contract price. The other part of the appraisal is going to be manually reviewed. If there's any issues or any questions with the appraisal, the underwriter may come back and say, we have questions, or the appraiser needs to go back out and inspect. Again, this takes time. You have to make an appointment. The appraiser needs to go back out. The buyer is going to have to pay an additional inspection fee. Let's say it could be $150, but they need to make an appointment. They need to do it. They need to resend the appraisal or the addendum in to the lender, has to go through the whole process. So this is something you want done earlier rather than later. You also want to make sure that the appraisal is completely signed off on, which means the underwriter reviewed it, has no questions, do not need additional information. It is removed from a condition. All right. So that's something you want to make sure. People think they can waive an appraisal clause. Even if you waive your right to get an appraisal, or you waive your right to have an appraisal, it doesn't mean that you can't go in and get an appraisal, all right? So you could say, I'm waiving the value that comes out on the appraisal. So if this guy bought a house for $100,000, the appraisal came in at 90, if he waived his right to the appraisal, this means that he can't go back and say the house is only worth 90, you have to come in lower, okay? But that doesn't mean he can't do an appraisal, especially if he's getting a mortgage because the lender requires the appraisal, all right? So the only thing they are waiving is the right to argue on the value. And even if my client was paying cash, I would still tell them to get an appraisal. It's really smart and really good to have in your records when you buy a house the actual appraised value. All right, so this is something you want. Another thing they want you to do is to waive inspections. This is something I would not do. Even if they say, I'll waive my right to argue anything that comes in, you still want to get an inspection. Or maybe they can waive their right to argue anything that the cost is, I'm making this up, $500, total cost $5,000, $10,000. But you don't want your client to go in and do an inspection and find out that the roof only has 3 years left or 5 years left, because this could come back in the appraisal and the lender's going to say that, you have 5 years left on this roof, we're not going to lend on this house. Or the homeowner's insurance company could come and do their own inspection and say, you have 5 years left on this roof, we're not going to insure it. And then your client, is left scampering for insurance or having to put a new roof on after they close. I mean, just because you're waiving a right, that doesn't mean that you can't do something. So this is something you want to instruct your client. I always want to instruct the client. But when the market gets very competitive, or there's very little inventory, people want to make themselves look better. And this is, a likely way. Anyway, you want to tell your client, hopefully your client knows who you are before they find a house or before they get involved in this, and you could tell them at the very least what your opinion is. All right. So number 4, applying for a mortgage with a visa. This is changing. All right. If you have a green card, which is a permanent resident card, green card, you can apply for a mortgage. No problem. You can get a mortgage. No problem. If you have a non-resident, okay, if you're a non-resident, if your client is a non-resident and they're here on a particular visa, a student visa, an athlete visa, a visa where they will be going back or maybe going back later on. This is where the issues come in, all right? FHA will no longer provide mortgages to people that do not have green cards. So if your client has a particular visa, then you want to find out more about this. Now, what do we do with if your client has a green card, you want the client to provide the documentation right away, right on application. They may have a visa, but it may have expired. The bank may say it expired. Have you sent your application in for renewal? Provide documentation, provide additional documentation. So you want to make sure if your client has a green card, again, if it's a condition, it's been reviewed, the documents are there, and it's been approved. If your client is in the country on a visa, you want to make sure that this category has not been excluded or will not be excluded or may be excluded by either A, Fannie and Freddie, or FHA, which is government insured loans, or a particular lender may be pulling back on certain visas for certain type of residencies for fear that they think the government or Fannie and Freddie may be pulling back or pulling out on the system because the lender doesn't want to get stuck with the loan. They don't want to find out that they just did a mortgage for somebody and now they've been deported, unfortunately. So this is causing problems. So basic gist, if your client needs to provide visa documents, you make sure that they provide it. This is something that I would get involved in if I was representing them. And you want to have this conversation with your client. Again, this could be something that delays or causes issues with the closing. Like FHA, a couple months ago, just pulled out. Okay, green card, yes. Visas, no. So and even if, incidentally, even if your client or a person has an FHA loan or has a particular loan and wants to do a refi, if it's not allowed, they can't do it. So again, this is changing. It's always changing. So this is something. If anybody has a question about a particular visa, you can email me. I always get the updated lists from the different lenders. So your client may not be able to go conforming for their mortgage. What happens? They're going to go non-conforming, which I'm going to talk about later, but this is a particular kind of loan that you want your client to go to a reputable lender, right? And go to a lender that understands the visa that they have, and that this particular lender, may be doing non-conforming loans, which I'll touch on later. If your client doesn't care where they get the loan, they just want the loan, you want them to go to a reputable lender. I'm going to touch on that in a minute. But next topic, number 5. Credit income assets, or credit asset income, is still the most important thing. All right. I just want to touch on each item. The lender is still going to require all this information, and they're still going to review it. So with this, a general overview of the process, your lender or your client will apply for a mortgage. Let's say they go into the portal, they put all their data in, they upload pay stubs, bank statements, etc. They press the button, submit. The next part of the process with the lender is they provide disclosures, which include many documents, but the one you want to see is the loan estimate. Okay, this is an estimate of the fees and money that the client will need for the closing. So this is an estimate, loan estimate, loosely built on fees that the bank pulls out of, a hat. So it's not going to be the fees that they end with, but you want to see this form. So client, they hit submit, lender hits another button, they send the disclosures, client should review them and not just hit sign, next. They probably do sign, next, and then submit. Once the client e-signs the documents, it's submitted to the lender. That's when the lender will send their loan to the next step, which is the processor. The processor simply reviews, make sure all the documents are there, or most of the documents are there in the portal for the underwriter then to start reviewing documents. One of the documents that's required is the contract of sale. So your client needs to have a contract of sale in order for it to go to underwriting. They don't need a contract of sale to submit the loan, but they do need a property address. They do need a purchase price. There's 6 points that they need. One thing that they do need to go to underwriting is a signed contract. Now, it can be signed by one party, which is the buyer. So if you're representing the buyer, once they sign, make sure they get a copy of the contract, because then they can submit it and move on to the next step with the underwriter. Once the seller signs the contracts, again, you want to send the fully executed contract to your client, if your client's the buyer, so then they have that, and that condition will be removed. Again, everything is reviewed. The contracts are reviewed. If there's an addendum that you put on that has weird stuff on, like they're going to pay $500 for the patio furniture in the back, that cannot be included in the purchase price, okay? So if you add your own addendum, just make sure that the items in the addendum will not require additional questions or additional documents by the lender. All right, so the underwriter reviews, they get a copy of the credit report, They will review the client's total debt. They'll review the client's monthly debt. Most importantly, they look at the FICO score. Your client, if you look at that matrix later on, it's the middle credit score. So there's 3 bureaus. They pull all 3 in their tri-merge credit report, and they use the middle number, numerically middle, not the one in the middle of the page, which I once had somebody work for me for a very short time because she thought it was the number in the middle of the page. So credit score. Then they look at the income. If your client is a teacher and they get a pay stub and W-2s, very easy. If your client is self-employed and owns a mechanic shop and they get paid in cash and, paid this way and that way and bartering, you want to make sure if your client is self-employed that they have the proper documentation. Nothing is better than the last 2 years' tax returns, but not everybody provides tax returns. Not everybody shows everything on their tax returns, etc. So if your client is self-employed, you want to make sure that they're on the ball, right? Assets, next item. Assets need to be verified. They get verified manually. Bank statements, not screenshots. Gifts. If your client is getting a gift from a parent or a family member, additional documentation needs to be provided. If they're borrowing against the 401k, additional documentation needs to be provided. So what would be the 3 biggest issues we have with assets? People don't provide the proper documentation. A lot of people don't get bank statements anymore, so they see nothing wrong with just sending a screenshot. Not acceptable. I have clients that move money from 10 different bank accounts because they think it's better if they took $5 from 10 different bank accounts, put it all in one bank account, then we need to source it. That's fine. But if they keep moving their money around and around and around, we need to source it. This confuses the underwriters. It gets delayed. Okay. Donors of gifts. If you're getting a gift, fine, no problem. But if the donor does not provide the proper documentation, it's going to cause a problem. So if your client is getting a gift, they need to make sure that whoever they're getting their gift from will be able to or is willing to give a bank statement. All right. Something like that. So again, delays. All right. Okay. You want to know your customer and all that. Number 6, there's other programs besides conforming programs. Conforming are just your regular A-paper, client has good credit showing all their income and all that. Fannie and Freddie, okay, have programs called Home Ready and Home Possible programs. These are like conforming, same pricing as conforming, sometimes better, but a little less strict, a little more lenient with the down payment, with gifts, meaning they could get a gift for 100% of what they need, better pricing for lower credit scores, loan to values can be higher. So these are good programs, but if your client is getting something called a Fannie Mae Home Ready or a Freddie Mac Home Possible, you need to know this because there may be other restrictions in underwriting that your client may need to deal with. The biggest restriction is the income limit. If you're a buyer, you're applying for this Home Ready or Home Possible loan, your maximum income is limited. So there's charts and they're easy to find. And the loan officer is the one that does it. Your client doesn't do it. You don't do it. But they will find out what the median income is in that area zip code, property address, and your client, some of these programs, they can go a little higher. Some of them, their income cannot be higher than 80% of the median income in this area. So a lot of times people want these programs because they can put less down, credit score, etc., but they make too much money. So this is something that needs to be addressed in the beginning. FHA loans, FHA are government insured loans. Now, people used to go, oh, it's a stigma to get an FHA loan. Really not. The guidelines are pretty much the same. Pricing can be a little better. The big difference with FHA versus conforming, if somebody's putting down less than 20%, they will pay mortgage insurance premium, which does not go away for 11 years, okay? Whereas if you do conforming or Freddie Mac, Home Ready, that the mortgage insurance can go away as soon as the client or as soon as the property shows the loan to value is under 80%. So there's a lot of different programs. You want to make sure you know which program your client's going for, and if they're going to a lender that knows how to do the program. And this leads me to non-conforming loans. For those of you that have been around as long as me, non-conforming used to be stated income, stated asset. If they were breathing, they could get a loan. Well, non-conforming is not really the same, but it's easier to get a loan than it would be if you were going conforming. So non-conforming, also known as non-QM, okay? This now makes up 40%. 40% of the mortgage industry this year, we'll say, maybe last quarter, maybe the last 3 quarters, 40%. That means that 40% of the people that are getting mortgages now are not going for regular Fannie and Freddie loans, which means that they can't or they don't want to provide the information. So a lot of these are investor loans, okay? People that may have a particular kind of visa, people that are self-employed, and these loans are fine. They're perfectly fine. They've really mastered the underwriting of them. You just really, really want to know if your client's going for a non-conforming loan, why, okay? Why they've chosen this, where are they going? And what kind of documentation do they need to provide? So I would get copies of this commitment letter all along the way, all right? 20% of all single-family homes now are investor-owned. 20% of single-family homes are owned by investors now. It could be me. Okay, I don't own any, but it could be a big investment company. It could be Zillow. It could be Open Door, which have gone into areas and are just buying up properties, okay, and renting them out or fixing them up and reselling them. And this is affecting pricing. It's affecting inventory. It's affecting rentals. So it's really changed the market. So remember that 20% of all single family homes are investor owned, and 40% of loans are now non-conforming. So nothing wrong with non-conforming, nothing wrong with FHA. You just want to know what your client is going for. All right. I'm going to start talking faster now. Condos and co-ops. Condos and co-ops, we do a lot of them here, okay? They have become harder to get financing for. Buildings, it's not the client, it's the building. So when a client is buying a condo or a co-op, the first thing we do is get a questionnaire completed by the management company. Management company charges for it, let's say $400, $300, $200, whatever it is. They're going to charge to complete the questionnaire. Each lender has their own questionnaire. They used to be 1 page, they used to be 2 pages. I just saw one that was 7 pages and had an addendum on it. So every question they ask in their questionnaire may lead to additional documents. So you want to make sure that the client pays for it and gets it done timely. A lot of times we won't even order an appraisal until the questionnaire has been reviewed. What are they looking for? They're looking for any issues that may be the building might have any issues like violations. Do they have enough reserves? Are there big assessments coming up? Are there big repairs coming up? Planned improvements. They want to know, do the reserves cover the improvements? Because if not, there's going to be an assessment. They want to know, do they have enough reserves? A building cannot take out a loan, an underlying mortgage, to cover their reserves. They want to look at their insurance policies because insurance has gotten very, very expensive for these buildings. They want to make sure they have proper deductibles, that perils are covered, perils such as wind, fire, smoke, riots, okay, falling objects. They want to make sure this laundry list of perils are included in the building policy. If it's not included, the lender will say, well, you need to get additional insurance for falling objects. And that means that the management company needs to request it from the insurance agent. And let's say the insurance agent says, well, this is going to cost you another $10,000. They're not going to do it. All right. So insurance needs to be reviewed early on in the process. They want to make sure replacement values, they want to make sure they have enough money for boilers and heaters. And if they only have 80% replacement value, they want to make sure the other 20% is in reserves there, not that they're going to take a mortgage out for it. Another big thing is repairs. All right. They want to make sure repairs are covered in reserves. They want to make sure there's no litigation. If there is litigation, they want to make sure the insurance is going to cover it. So these are things that are all fine as long as it's reviewed, properly documented, and signed off on. The best thing would be to get a building that's already approved. All right. A lot of lenders have building approved lists. Fannie and Freddie have building approved lists. If your client is buying in a building, the first question they should ask their lender, is this building on this list? Because that'll cause a lot less heartache for you. Another thing you should get in the beginning of the process, your title report, your lien search. Don't wait until the end. They review it as part of the conditions. If the underwriter has questions, it may delay. If the name of the lender is wrong, if the name of the buyer is wrong, the name of the buyer needs to match the contract, needs to match a government issued ID, okay, active ID. It can't be an expired library card. It needs to be a driver's license or a passport. So you need to make sure your names match. Always an issue at the end. Last, number 10. The loan is not clear until the underwriter says it's clear, and the underwriter says that the buyer has enough, okay, money in the bank, verified funds to close. And this means that you can't do your adjustments. You can't review your fees 2 days before the closing anymore. Get a copy of the loan estimate. Get a copy of the preliminary CD, which the lender does not issue until the loan is locked. Okay, I can lock a loan 3 days before it closes. And then the preliminary CD is going to come out. And then you guys are going to start doing your adjustments, and the title company and the tax escrows. And, oh, they didn't pay their homeowner's insurance. And lo and behold, they're short $10,000. Underwriter says they're short $10,000 and we're not clear to close. Buyer starts to cry. Where are they going to get the money? Okay. Again, we can increase the loan amount. They can get a gift. They can show pay stubs. They can get a loan against their 401k. But you don't want to do this 2 days before the closing. It just creates too much stress.
I'm just
So,
gonna pop in real quick. I'm sorry to interrupt you. Give the code for the course. The course code for this lecture is loan. The course code for this lecture is loan.
that's a good one. All right, so I'm going to end with this. Point being, there's a lot of things, moving parts. There's a lot of things that may change, okay, during the course. The key for you is to stay on top of your client. Make sure your client's going to a reputable lender. Make sure they're on top of everything. Make sure if you're doing a unit that the building is also approved. Even if you're the best buyer in the world, the building might not be the best building. Make sure that you do your adjustments as early as possible and just stay in touch. Stay in touch with the bank attorney. I know from the bank attorneys, it's always last minute, chaos. So you just want to avoid. Anyway, I hope I didn't talk too fast. And Diane, I'll turn it to you.
You're perfectly on time. 50 minutes. I just had a couple questions that I figured I'd ask before we wrapped up. Somebody had a question about co-ops. Do you suggest always getting an appraisal and an inspection for a co-op?
I didn't say for a co-op. I would always get an appraisal, but inspections for co-ops, some people get them, some people don't. There's not a whole lot to inspect. You can inspect the appliances, right? And, they could go check out the boiler, but not a lot of people get them.
If a married couple applies for a mortgage and one of them is a legal resident under the DACA program, but not a U.S. citizen, will this be an issue?
So I would remove the person that's under the DACA program, and assuming the other person can qualify on their own.
And last thing was somebody had a question about HPD loans. Do you have any insight as far as HPD loans when they're getting them in conjunction with a regular mortgage?
Again, it depends on where they're going, for the loan. I'm not that familiar with them, so I can't really answer that. I could do specific research if they want to reach out. So I don't have enough info to answer that one.
Sounds good. And one other question, somebody said that they usually request a lien search after board approval. Do you suggest that they get them before board approval for co-ops?
I would, but a lot of people don't want to spend the money. I think if you think your client may get rejected from the board, then wait, because a lien search comes in pretty quickly. Right? So if you think the client may get rejected, wait, but if you don't, get it.
Sounds good. Hold on, we're getting a few more in. What type of documents do banks look for if the buyer gets a gift toward the purchase?
There's a gift affidavit that needs to be completed by the donor and the donee. It's not an affidavit. It doesn't get notarized or anything. So it's a gift affidavit. It's a form, so don't write a letter. They want to see the money going from the donor to the donee. A lot of times it's a wire transfer. So some lenders will ask for the actual bank statement from the donor. Some just want to see the wire. They want to see the money coming out of the donor, going into the donee and clearing. So if you're getting a gift, it has to clear and be in your account.
Sounds good. Well, thank you for another great lecture. I think we got to most of the questions. If anyone has any questions that weren't addressed, shoot me an email. I'll get them over to Dale and we'll get them answered for you. Once again, thank you for a wonderful lecture. Thank you all for coming today. I will resend all the materials this afternoon and you will get your certificates next week. Have a great day, everyone.
Thank you.